Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley Chapter of AAII. We welcome you to a terrific program this morning. We had a few cockpit problems this morning, which are not unusual with computers, but would like to welcome you and hope you're all well and doing fine. I'd like to make a couple of comments about future programs and then go into the introduction of Mark Hulbert. For those of you who've been with us for a while, you know that we can always use some help with some of the functions of the program. So anybody who would like to volunteer to do things like film edit, video editing, or recruiting speakers, you're welcome to join us. And so you can contact any of the board members if you'd like to do that. Today's program, we're going to have over 100 participants, so any questions should be done through clicking on the chat button, either the top or the bottom of your screen, and just typing in your questions, and then we'll hand those questions off to Mark as fits with his presentation. And let's see. And I'm also in charge of admitting people, so that's one of the things I'm going to be doing. Okay. Mark Hulbert was founder of the Hulbert Financial Digest and writes columns for Dow Jones and MarketWatch, and has been in this business since 1980. I subscribed to his service myself and found it very useful over the years because he did a great job of rating various newsletters and commentators and actually telling people what the actual performance was. Mark is a seasoned financial expert with over 4 decades of experience analyzing investments and market trends. He is adept at translating complex investment concepts as a columnist, newsletter writer, editor, and frequent guest on TV, radio, and a leading investment seminar at leading investment seminars and workshops. In 1980, Mark founded the Hulbert Financial Digest to objectively rate the performance of investment advisors, newsletters at that time. The HFD was bought by CBS MarketWatch in 2002, which in turn was acquired by Dow Jones. I run an investment discussion group as a special interest group for this chapter. And one of the greatest sources for discussion topics is often to just pick out a column written by Mark and discuss that. That's been very useful over the years. I also have great respect for his ability to look at the market and in a very objective way, talk about what's going on. And he's very rigorous in terms of honestly evaluating and being very transparent in the way he does his analysis. So I think the topic of Mark's presentation is why contrary analysis works and what it's now saying in the stock, gold, and bond arenas. So Mark, you have the forum, and hope everything goes smooth with these wonderful computers that we use all the time.
Yeah, you and me both. So thank you very much, Lynn, for that introduction. I'll just confirm, Lynn, you can hear me, right? Everyone?
Yes.
Good. So that's always a good sign. So I chose this topic on contrarian analysis because I think it follows from a number of the conclusions that I've reached tracking investment newsletters, though it seems, I think, on the surface, a rather odd corollary to what I found, which is on what works and what doesn't work in the market. As I'll go into in a minute, most of the strategies we track do not beat the market. So you might think, well, that seems odd. Why would you even try to beat the market if most of it doesn't work? And I'll try to explain that apparent contradiction as we go through. So there's basically 3 sections of what I want to go through, and then I hope we'll have plenty of time for discussion at the end. If there's a question that is pertinent to understanding one of the charts that I have, one of the overheads, go ahead and put that in the chat right away, and Celia or Lynn will be able to monitor that, and they will feel free to interrupt me and ask the question to make sure there's no misunderstanding. Otherwise, it might be better just for the flow of the of the next hour and a half for us to wait until the end of what I want to go through from a more of a prepared point of view and have a discussion then. So that's more or less the outline of the morning. So here are the three sections I want to talk about. One is I want to talk about how difficult it is to beat the market. And in that section of what I have, I think you will find it's something you already know, though it's worth going over because I think people forget about it, even though they know it's true. They would rather not have it right in front of them every time. And so that's where I'm going to just review the statistics of what I've been doing over the last 40 years. The next section will be an interesting corollary from some statistics on why it makes sense to continue trying to beat the market even when it appears impossible. That's an apparent contradiction that I want to spend a few overheads and discussion on. And then the third section will look at contrarian analysis in particular. So this screen just is a review of what I've been doing over the last 40 years. Lynn reviewed that very well. So let's go to the next overhead. So as Lynn mentioned, I sold my newsletter. People want to know, do I still track investment newsletters? I do, but under a different business model. You'll see from that second bullet item that after Dow Jones shut down my newsletter in 2016, we have had to go to a model in which if newsletters want to be tracked, they pay us a flat fee to have us audit their returns using the same methodology that we used when my newsletter was in existence, the Hulbert Financial Digest. It's not an ideal business arrangement. We'd rather not be in the business of being paid by the newsletters we track. We feel as though having a flat fee reduces any incentive we might have to make one newsletter appear better than another. And indeed, I can tell you we follow the newsletters the same way that we did before, but appearance of impropriety is always something to worry about. So I want to stress that newsletters pay us a flat fee to calculate the returns, and we have no incentive to make one better than another. Because of that business model that we now use and been using for the last 7 years, the track records are available free of charge, and there's my website there at the bottom. So, you know, people will tell me, hey, how do I subscribe to your service? I can tell you there's nothing to subscribe to. You can go to that section of my website and see which newsletters, which track records of the newsletters we track. I should tell you that we don't have as many newsletters in our monitored list as we used to, and that I think is perhaps a flaw of my business model. I mean, newsletters, most of the newsletters have not done well, and given that, it's not a big surprise that they wouldn't want to pay us to continue to track them, because why would they want the world to know how poor their track record is? So what has happened is that only, I would say, about 10% of our previously monitored list have continued to want us to track them. Now, they are the best performers historically, so I don't think that users of my service are that much worse off, except to not see the track records of those newsletters that have particularly poor returns. But anyway, that's basically the background. Let's go to the next slide now.
Mark, there was a quick question that's kind of pertinent. It asks, why did Dow Jones shut down your newsletter in 2016?
Well, that's a very good question. And the easy answer is that I wasn't making any money for them. I mean, when they bought CBS MarketWatch, they wanted a website presence. And CBS MarketWatch had an excellent presence in the market on the website. And so given that they wanted that, I was just sort of a footnote in the balance sheet of CBS MarketWatch, and I came along for the ride. And they, I don't mean to be critical of them at all. They didn't know what to do with my newsletter. They didn't want to be in the newsletter business per se, and they didn't want to spend any money on marketing, which I understand. They had a tight budget. So basically, my business basically frittered away over many years. From 2005 to 2016, it became less and less profitable every year. And I think the year at which it became break even or worse, they decided to shut it down. So that's the history there. So back to the narrative of what I want to talk about, which is that I want to talk about how difficult it is to beat the market. And I want to stress that I don't want to just review statistics and say, 90% or 95% of managers don't beat the market. Those are statistics we see all the time. We know that they're true and so forth, and they are very sobering. But the real key is return persistence. If only 5%, let's say, of managers beat the market and they continue to beat the market, do we care really that the other 95% haven't done well? So I want to focus on return persistence. Do those who beat the market in one period have an above average chance of beating the market in the subsequent period? So let's look at that. Go to the next slide. So this is perhaps a little more complicated of a chart. In PowerPoint, I could bring up each of the colored bars in turn to explain them. But basically, what I did is look at all newsletters since 1980, and I created for each newsletter for each year where it was in the percentile ranking for its performance that year and where it was in the subsequent year. So imagine a pair. Okay, so the newsletter I started following in 1980, I'd say, well, let's say it was at the 57th percentile in 1980, and it was at the 43rd percentile for its performance in 1981. Then I do the same thing from 1981 to 1982. I create a pair. So basically, I'm looking at all pairwise combinations of their percentile rank. This, if you can imagine, I had hundreds of newsletters, hundreds of portfolios every year over a 40-year period. So this chart was based on thousands, over 10,000 pairwise combinations. And so what I wanted to do, and let's look at the very first set of columns over at the left. So in the set of columns that has the label best 10%. So let's say this includes and reflects all newsletters that were in the top 10 percentile of the returns in a given year. Now, if there's good return persistence, you'd expect that they would be also in the top percentile, top decile, I'm sorry, the top 10% for performance in year number 2, which is to say that their ranking would be more or less persistent from one year to the next. So that's what that purple bar over at the left. So you'd say their average percentile rank in year number 2 would be 95%, which is between 90 and 100. So that would be the top decile on average would be at the 95th percentile. Then if you look at if you go across the horizontal axis to the bars that are labeled second, so if they were in the 80th to 90th percentile range, in other words, they were in the second decile in the first year, and return persistence was a feature of the market, you'd expect that their average percentile rank in the second year would also be at the 85th percentile. So you can see those purple bars go down monotonically, 95, 85, 75, all the way down to the 10th percentile. That's what you'd expect in a regime of pure skill. In pure luck, those are the green bars. You'd find that everyone was at the 50th percentile in year 2, regardless of which decile they were in year number 1, which is to say that that would be pure luck or randomness. So the green bars is what I want you to focus on. Excuse me, the red bars are now what I want you to focus on. This is the actual results I came up with, looking at all pairwise combinations since 1980. And look at how close those red bars are to the green bars, which is to say how close the actual performance is close to what you'd think it would be on the basis of pure luck or randomness. So this really is a core of what I have found. The only statistically significant deviation from luck, believe it or not, is at the bottom of the ranking. So if you go all the way over there to the right of the chart, you'll notice at the 10th decile, that the actual performance ranking, the average percentile ranking for year number 2 is down, I think it's at 39%. So instead of expecting it to be 50%, if you're at the bottom at the 1 year, you're probably going to be below average for the next year. But once you're at the 8th decile or above for performance in year number 1, your expectation is so close to being at the 50th percentile the next year as to say that it's not statistically significant from randomness. So that, I want to stop there. Go ahead and ask any questions, and Lynn can pass them along to me. this to be understood, because this is a key for understanding the basis of what I'm going to be talking about in the later part of this presentation.
There was a question about, have you tried applying momentum models to these newsletters? If you did, what is the optimum look back period?
Yes, the answer is yes. I mean, there are a number of ways of measuring momentum, often known as hot hands. The idea is that, okay, a newsletter that's playing a hot hand will, continue to be having a hot hand in subsequent periods. But this, think about this chart. This is a test of the hot hand phenomenon, and it's not there. The only deviation from randomness that we see in this chart is a cold hand phenomenon. Down at the bottom of the ranking, it seems like there are people who play cold hands. But let's look at that first decile, though, all the way at the left. You'll notice from the red vertical bar there that it's around 51%. So that is not statistically significant from 50. That's basically to say that you can be in the top decile for year number one, and the best guess from a statistical point of view is that you're going to be purely average, right at the median in year number two. So it's a very sobering phenomenon. Everyone thinks there's this notion of a hot hand. It seems intuitive. I understand it. We all do. We think, why would we go with anyone else but somebody who's winning? But nonetheless, this suggests that there's not a good statistical basis for that belief. We can come back to this, but this is basically the message, even if you don't want to go through all the noise of this chart, is basically there's very, very little return persistence. The hot hand phenomenon, as many of you probably know, first was tested in the basketball arena. The idea that if somebody was playing a hot hand, all of a sudden they were doing better than their average in terms of hitting three-point shots or whatever, hitting free throws. And so the question is there an above average chance? Do they do better than their historical average on the second shot after hitting a first, or after hitting two shots in a row? Is there a chance of hitting a shot on the third? And it turns out that the statistics suggest there is no such thing as a hot hand in basketball as well. That isn't to say that Steph Curry doesn't do better than, let's say me, for example, but nonetheless, what you'd compare Steph Curry to is his average for the season. How many three-pointers does he hit on average? And the question is, when he's starting to be at a higher percentage of hitting his three-pointers, does he continue to hit a higher percentage than historical average? And the answer is, at least according to the statistics I've read, the answer is no. And the same is true in the investment arena, as this chart shows. Okay, let's go to the next chart. So this is just a different way of looking at it. Instead of looking at 1 year return, I look at 5-year returns. And now I'm looking at, rather than deciles, I'm looking at whether you're above the median or below the median. This is just a different way of slicing and dicing the data. So instead of looking at deciles, I look at median, above and below median. And rather than looking at 1 year, I look at 5 years. So the first vertical column over at the left is performance between 2003 and 2007. That's a 5-year period. So the question is, how many newsletters were above median in that year? And as you'd expect, by definition, 50% by definition will be above median. And that's what both the blue bar, which is what you'd expect on the basis of randomness, and the red line reflects the actual percentage of newsletters over that 5-year period that were above median. So that's what you'd expect. So now the question is, let's look at the subsequent 5-year period, which is now the second vertical column. That's how many newsletters were in the above median, both in that first 5-year period and the second 5-year period. Now, on the basis of randomness, that would be now down to 25%. Half of those that were above in the first period would be above in the second period. So if just we were flipping coins, you'd expect now 25% were above median for 2 successive periods. Well, you can see the red line is very, very close to what you'd expect. Now let's look at the third vertical bar, the vertical column, I mean. So now we're talking about 3 successive 5-year periods. and how many were above median for each of those three. Well, if you were flipping coins, you're just doing it on basis of luck alone. Now you'd say half of 25% or 12.5. Notice that's where the blue vertical column is exactly at 12.5. The red line couldn't be closer to 12.5. It's almost exactly on line. Again, what you'd expect on the basis of randomness alone. And then you go out 4 periods. So I looked at the last 4 5-year periods, so it was going back 20 years. Now you'd expect half of 12.5 for 6.25. And indeed, actually, you'll see that red line is a little bit below 6.25. So in other words, the evidence, though it's not statistically significant, is that maybe people are even worse than you'd expect from randomness alone. So this is just another way of slicing and dicing the data to make the same point, that the evidence in favor of persistence is remarkably slim. And this, by the way, is what I did with investment newsletters. But if you did this with mutual funds, hedge funds, you name it, you're going to come up with a remarkably similar chart.
Mark, I've got a question that seems to be pertinent. For mutual funds, I look at Morningstar year-to-year quarterly rankings. Is that not significant?
Well, I have not done it with the quarterly rankings, but I'm confident that it would be something similar to this. If anything, when you start looking at shorter periods of time, so in other words, instead of looking at 1 year, and now in this case, 5 years, if you're looking at quarterly, you are, the evidence suggests that luck plays a much bigger role when you're dealing with shorter term performance. And so therefore, you'd expect it to be, if anything, even more sobering than what the statistics here suggest. But I have not looked at quarterly, but I'm willing to bet it's very similar.
And then one more and then we'll stop for a while. Have you considered subsetting your return analysis by type of newsletter? Example, looking at tech, industrials, or bonds, following newsletters separately?
I'm sure there are ways of slicing and dicing the data that would suggest that somebody could suggest, but I've sliced and diced it every way you can imagine. I mean, value versus growth, small cap, large cap, you name it, and the conclusion remains remarkably similar. Okay, let's go to the next screen. So now this is now the beginning of my section number 2. Why would you, given the data that I just had, you might say it's irrational to try to beat the market. I think it's still rational to try, and I want to deal with it. This is something that I've been focusing on relatively recently, and it's a fascinating different way of looking at the data. It turns out that a number of people have been applying Bayesian statistics, and I'll describe Bayesian statistics here in a minute. And you apply this, it's a different approach than normally has been used in the finance arena. And you apply it to the probability of beating the market, and you come up with some very provocative conclusions. So Bayesian statistics basically shows us how to update probabilities in the light of new information. I want to go through one example, which is the way that the professor at Yale described it to me in a way that he thought would be relatively straightforward. Let's see if I can succeed as he did with me. So basically, let's say we want to know whether my wife, despite having brown eyes, has genes for both brown eyes, which are dominant, and blue eyes, which are recessive. So my initial guess, which is known as a prior in Bayesian terms, is that there's a 50% probability that my wife is a hybrid, and that's the population average. So basically, of all the people with brown eyes in the population, half of them are hybrids, have a recessive gene for a different eye color, and half of them have only genes for brown eyes, which is the dominant gene. So now we want to know, how do we update our probability, our guess for whether she is a hybrid or not a hybrid for eye color after each of our children is born. So if our first child has blue eyes like me, then we know for sure that my wife is a hybrid, because she has brown eyes, but clearly the only way that our child would have blue eyes is if there's that recessive gene is expressed in our child. But let's say if our first child has brown eyes, the probability that my wife is a hybrid falls to 33%. And Bayes talks about how you would update your probability. Your prior is now, instead of 50% at the beginning, our prior is 33. But then we each, let's say we have a second child who's brown-eyed, that probability now continues to fall from 33, and it would fall continuously with each brown-eyed child we have, but it would never reach 0. And that's crucial. It would never reach 0. So let's go to the next screen. So the question really that you can see a citation of, it's a fascinating study. It was in the Journal of Finance 20 years ago. So it never got the publicity I think it should have. It's a guy at Wharton, a guy at Yale, and a guy at Georgia Tech, or I'm sorry, at Emory University. You can see the three of the authors there. So basically, this title of their paper was, "Should Investors Avoid All Actively Managed Mutual Funds? A Study in Bayesian Performance Evaluation." So the question they started out by asking is, how skeptical must our prior be? In other words, what is our predisposition when we approach looking at performance statistics before you say it's rational to try to beat the market? So they went through a number of hypotheticals. So you see from the third bullet there, let's say if your prior is that only 1 out of 10,000 managers has genuine market beating ability, how much should you allocate of your equity portfolio to that manager? And believe it or not, well, of course, you don't know which manager it is. You just know that that's the probability. Then you would take 25% of your portfolio and allocate it to the manager with the best track record. They says that is a rational response given a prior that only 1 out of 10,000 managers has ability. Now, let's say if you relax that and say, okay, well, that seems awfully skeptical. Now, let's say we believe that only 1 out of 1,000 instead of 10,000 has ability. Then they conclude it's rational to allocate about 50% to active management. So then the last bullet is an interesting question. How skeptical must your prior be to say you should only be in index funds and in nothing else? And the answer they came up with is, we do not have enough data to reach that conclusion. In other words, given the amount of data we have, we cannot tell the difference between very rare ability to beat the market and no ability to beat the market. And that's why I came up with this title of the second section of what I want to talk about today, that it's still rational to try to beat the market, even if you agree with all the data that I have and other data that I'm not even reviewing today, of just how difficult it is to beat the market. So that really, I want to stress that, because otherwise, a lot of feedback I've gotten from prior discussions at AAII chapters and others is that, why should you even try to beat the market if you believe the data that I come up with, which is it's so hard to beat the market. And I'm not saying you should not put all your money in index funds. That's one response. Or you can say, I want to allocate a quarter or half my portfolio to try to beat the market. That's also a rational response. And their point is, you cannot, from statistics alone, differentiate which of those is the more rational response. So it's not irrational to still try to beat the market, even though the data make it lead to a lot of skepticism about that ability. So I just want to stress that, so that at least you can keep that in mind. I recommend that study if you want to get into Bayesian statistics a little more, but it's a fascinating study. So let's now go to contrarian analysis. That's the next slide. So clearly, randomness and luck are playing a big role. I think everyone would agree with that. But there's something more besides, since the results are even worse than would be expected on the assumption of pure randomness. So I want to go through a couple of slides to explain what I mean by that. So let's go to the next slide. I talk about it as negative skill. We're not just talking about transaction costs. Transaction costs will be a major factor. So even if you or I could only pick stocks no better or worse than random, in other words, by flipping a coin, pick our stocks, we would still, on average, underperform the market because of transaction costs. And so if we think about it, how much does Wall Street earn every year? If you look at the Federal Reserve statistics, it's hundreds of billions of dollars they get in fees. That's the amount by which we collectively underperform the market. So that we have to keep in mind. But what I'm talking about here is above and beyond transaction costs. Then for want of a better term, I'll call it negative skill, which is even if transaction costs were not a factor, on average, we're not doing as well as the market. And how can that be? And the answer is that there's this negative skill. I want to go through a couple of slides to explain what I mean. So let's go to the next slide. So this is from this is a study that's been talked about in AAII journal many times. It's a fascinating study out of it's Terry O'Dean at UC Berkeley came up with this. It was basically he did a study of the trading histories of something like 64,000 accounts at a major brokerage firm, discount brokerage firm. He didn't identify the firm. He didn't get any data that would give any details as to who the owners of it accounts were. But basically, he was able to look at all the trades over something like a decade's time, an enormous database. So what I want to focus on here is just one of the charts he has in his study of those trading histories. He basically wanted to know if we sell a stock and buy another to replace it, how does the stock that we sold do relative to the stock that we bought? And of course, he doesn't know the intent of each one of the traders. So he basically makes the following assumption. If I sell a stock and buy another stock within 30 days time, I'm making the implicit assumption that that one I have bought is to replace the one that I've sold. And I think the one that I bought will do better than the one that I sold. Now, there could be many other explanations, but that seems to be a fairly safe assumption. So what he wanted to do, he didn't even look at transaction costs, no bid-ask spreads, no brokerage commissions. He basically compared the performance of the replacement stock with the performance of the stock that was sold. And you'll see that because each one of these vertical columns is in the negative region, every one on average over every one of those time periods, on average, the stock that we buy to replace a stock that we sell does worse. So over a 4-month period, you'll notice it does about 1.5 percentage points worse. Over a year, it's over 3% worse. And over 2 years, it's closer to 4%. And isn't that amazing? This is an average across 64,000 accounts. So over a 10-year period, it's an enormous database, hugely statistically significant. Does that mean every one of us does this poorly? No. Does that mean that each one individual trade, maybe one person on average over 10 years does this bad, but some trades you'll do better with the one we bought than the one we sell. But on average, across 64,000 retail investors, this I think is one of the most overwhelming statistics. Like, we have to realize that on average, what we do is a mistake. On average, what we do causes us to lose above and beyond what we pay Wall Street in the form of transaction costs. And this is what I call negative skill. Why is it that when we pick a stock to buy to replace the stock we've sold, we pick a stock that does worse? And there are a number of possible explanations for that. There's a whole field of behavioral economics that tries to focus on that. But I'm not going to go into that today, but this is an overwhelming statistic. Again, it's not just transaction costs. Even apart from transaction costs, on average, what we do is a mistake. So let's look at the next slide, which is another way of slicing and dicing the data. So this is just a setup for statistics I'm going to show you on the subsequent slide. So consider what would happen if we froze our portfolios into place on New Year's Day and did nothing for the rest of the year. If our trading added value, then our actual portfolio should have done better, should have performed better than our frozen one. So basically, this is the setup. I did this for each year going back to 1980 for all the newsletters we track. So again, hundreds and hundreds, if not thousands of portfolio pairs. So each pair has the actual portfolio, and then the second half of the pair is their hypothetical frozen portfolio. And my what I wanted to do was to see whether the frozen portfolios did worse or better than these newsletters' actual portfolios. So let's look at the subsequent slide. So here is the amount by which the frozen portfolios did better than the actual portfolios. In other words, this is to say, this is how much our trading cost the average newsletter. So you'll see in that first vertical column, newsletters that spread between the frozen portfolios and the actual portfolios is about 75 basis points. So on average, the newsletters did worse with their trading by the tune of about 75 basis points. The second column you'll see is mutual funds. This is a study that was done a number of years ago, but it was an academic study of mutual funds applying the same test, basically comparing mutual funds to their hypothetical frozen portfolio, and came up with remarkably similar conclusions. So again, this is just a different way of slicing and dicing the data to show that on average, what we do is a mistake. Well, this turns out to be the core of contrarian analysis, because if the average thing we do is a mistake, then we should do the opposite of what we want to do, right? This is what causes the Hall of Mirrors effect of contrarian analysis, is that, but you know, the famous saying is that we ought to buy when the blood is running in the streets is a way that it really brings that home. In fact, I was just looking at it the other day, supposedly the more lengthy quote, it's from a guy named Baron Rothschild hundreds of years ago, but was the full quote is, buy when the blood is running in the street, even when the blood is your own. And so of course, that's the last thing you were going to be thinking about doing, is when your blood's running in the streets, is to go out and buy. But that really is the core of it. Warren Buffett says something similar. He says, our job is to be fearful when others are greedy and to be greedy when others are fearful. The same fundamental idea. So if everyone says, oh, we ought to be buying tech stocks, well, chances are that we might want to, you know, at a minimum, question whether that consensus is correct. If not, actually do the opposite. If everyone says interest rates are now, you know, I don't know what the consensus is on interest rates. We'll talk about that in a minute. But let's say everyone says now interest rates are going to fall. You might say, you know, is that really true? And if it is true that everyone thinks that rates are going to go down, then you have to ask the question, hasn't that expectation already been discounted in the marketplace? So you'd have to not just be right that interest rates are going to go down, but you'd have to be right that they're going to go down even further than people already think they are, because what we already think is the case is reflected in prices. So anyway, let's go to some more of these overheads.
Do you want some questions, Mark?
Sure.
Okay. I got three, and I'll.
Okay.
So paying someone to help you beat the market is equal to randomly trying to beat the market yourself. Well, no, I'd say the same probabilities apply, whether you do it yourself or whether you have somebody help you. You know, the odds of beating the market are very poor, but on the other hand, it's possible that the person who helps you beat the market may be one of those with genuine ability. So it's not irrational to try to beat the market with a portion of your portfolio. But what you would do is look at that person's track record over a long period of time. Just as, you know, let's say your prior is that the ability is very rare, but you have a manager who beats the market every year for 10 years or in 5 successive 5-year periods or whatever it is, you would sooner pick that advisor than somebody who has lagged the market for 10 years in a row, or each of 10 years in succession and so forth. So you would want to pick somebody who's going to help you. I will add, though, that the more layers of fees that you add, it just makes it that more difficult to beat the market. So typically, somebody, quote unquote, helps you, and a financial planner, then they will in turn pick an advisor who will be picking your stocks. And so you're paying your financial planner, but you're also paying indirectly the mutual fund fees or the fees of whatever manager that you pick, and it just becomes increasingly difficult to beat the market.
But the overall probabilistic analysis doesn't change if you have somebody helping you.
And the next one is, what if I sell an underperforming stock and buy a CD?
Well, the same set of odds apply. The reason you think that the stock ought to be sold is you think it's going to do poorly, and you obviously think the CD will do better. It doesn't matter which security it is. Now, let me, the presumption of the question is you're selling an underperforming stock. Well, that means it's underperformed in the past, but does an underperforming stock in the past automatically underperform in the future? No. But that's one of the behavioral reasons that lead people to sell. I argue with my wife all the time about this. She's not somebody who, is she doesn't feel all that confident in the investment arena. But her reasoning is along those same lines. If the stock's going down, she says, "Well, we shouldn't buy it." Well, if we could turn the clock back, yes, we shouldn't have bought it. But that doesn't mean it's going to be a poor bet going forward. In fact, there's some evidence that there's a reversal phenomenon in the markets. Not a strong one, but there is some evidence of reversals. So it may be that there's an above average chance of a stock doing well if it has been a poor performer in the past. That's the basis of the value effect, believe it or not. The value stocks will outperform growth stocks. So I want to call into question the presumption that you have in asking that question, which is that it's an underperforming stock, so therefore a CD will do better. CD will do better if it continues to underperform, but that's precisely the question that and the assumption that should be called into question.
And then one more, and then we'll just go on your topics. What if I sell an overbought, overvalued stock and replace it with an oversold, fundamentally strong stock at a later time?
Yeah, I mean, if indeed the things perform as expected, then that's a good trade. But that's precisely what the statistics suggest doesn't always work out. Value has outperformed growth over, on average over the last 100 years, but there have been significant periods along the way in which they haven't, as you know, the last, up until about 2007 to 2020 or so was a period in which growth outperformed value. We all know this. I mean, I'm just repeating it, but outperformed value by more than any other period in time. The thing we have to remember, and I'm not saying anything that any of us don't already know, but it's worth repeating, is that an undervalued stock may do better than an overvalued stock, but it has to do better than the market already expects. And so if you're competing with a number of other value investors out there, when there are always going to be some, their expectations are already baked into the price. So your expectation can't be, let me put it this way. You're not going to make money by just being right. You have to be more right than the consensus already expects, if that makes sense. So, if we think that, I don't know, just pick a stock. Let's say Tesla is going to do well over the next year. It may do well and the stock does poorly. And that's because for the stock to do well, the performance of the company has to be even better than what is already expected by a number of bullish investors. And so this is why John Maynard Keynes has that famous quote, which is that investing is like betting who will win a beauty contest. And I think it's a great analogy. He says, let's say you and I were trying to bet who's going to win, Miss America contest. We wouldn't bet according to who we individually thought was the most beautiful candidate, but rather who we thought the judges would think is the most beautiful candidate. And that's a different thing. And so we have to remember that we're trying to bet against the behavior of our fellow investors. So anyway, I'll continue and we can come back to any of this, of course. So this is what leads to what I really want to talk about as the core of today, is that contrarian analysis, I think, follows from what we've been talking about. The first section, we really went through how much luck plays a predominant role, but we also showed that our emotions overreact by leading us to buy when we should sell and sell when we buy. And if both of those presumptions follow, then notice that on average advisors will be wrong, and that's what we see. And this is exactly what contrarian analysis believes, that we should be doing the opposite of the consensus. At a minimum, even though that doesn't mean we sell short what they're buying and so forth, which can be a fairly aggressive strategy and not always a good idea, but it means we don't necessarily jump on the same bandwagon they are when you see that there's a strong consensus forming. So let's look at the next slide. So this is why I became interested in sentiment about 15, 20 years ago. I've been tracking these newsletters since 1980, and I would start realizing that there were patterns, that short-term market timers were very bullish at tops and very bearish at market bottoms. Again, this is not a huge earth-shattering insight, but it turns out to be a very regular pattern. And it turns out contrarian analysis says that we can use those extremes as a guide to when we should put more money into the market, or if we have to pull money out of the market, we pick at a time that contrarian analysis says would be optimal. So let's keep going. Another way of just coming at the same conclusion is I think we need to focus on sentiment in order to explain advisors' poor track record. Without sentiment, I don't think you can explain why we've seen the track records we have. Why would it be, if things were random, you wouldn't expect that their performance on average would be worse than the market, even without taking transaction costs into account. So if we didn't have sentiment and contrarian analysis in general to explain, I think the question would be very clearly in front of us: how do we explain the results that we have? And obviously, I think sentiment is the missing key, or at least one of the big factors that explains their poor performance. Okay, let's keep going. So, okay, this is a chart that I had before. I just repeated it, so let's just keep going. So the question is, how do we exploit contrarian analysis? And I wanted to just take a little bit of a tangent and say, contrarian analysis all too often has been used as an excuse for sloppy thinking. And I want to use an example. A lot of people will refer to what's known as a magazine cover indicator. I think most of us are familiar with it. Basically, it all traces back to the 1970s, where Business Week, it's now part of Bloomberg, but it wasn't part of Bloomberg back then. Business Week had a cover at the bottom of the 73, 74 bear market, which was the worst since the Depression. And it said, the death of equities. And so it was right at the point of the market bottom, they were saying, equities had died, basically, avoid them. And then at a subsequent market top, within the next decade, I don't remember the exact date, they had a magazine cover called The Birth of Equities. So that led people to think, oh, well, what Business Week puts on their cover, you should do the opposite. Well, that's just sloppy thinking. Business Week has 1 million covers. It comes out weekly, obviously. So, and if you did the opposite of it, it turns out to be, you wouldn't necessarily, first of all, you wouldn't even know what to do the opposite of sometimes. Let's say they have a picture of something just in the economy as a whole. Well, how would you do the opposite of that, and so forth? So, so I think, and this is what I really want to stress, for contrarian analysis to be of any value, you have to have an objective measure of sentiment. Otherwise, you are basically, you can see what you want to see. I mean, I remember at a conference, it wasn't an AAII conference, but years ago, I was the MC of a panel discussion. And I kid you not, every one of the speakers, there were 4 speakers on the panel, each one of them introduced themselves as a contrarian. They said that what they were about to say, they were the only ones in the market who believed it, so therefore they must be right. Well, they were all contradicting each other. There's no virtue of being alone necessarily. There are many, many ways of not being part of the consensus. I mean, let's say the consensus is the market's going to go up modestly by the end of the year, and the S&P might be at 4,600 or something. I'll just make that up. But how would you say that that consensus would be wrong? Well, one of them could be, well, it's going to go to 6,000. Another could be, it's going to go to 2,000. There's so many different ways of being the opposite of consensus. So you need to have an objective measure of sentiment so that you're not just seeing what you want to see in the market and then trying to wrap yourself in the contrarian flag to justify your position. It's a marketing technique more than it is a statistical technique in the hands of many advisors. So let's go to the next slide. So what I do in my objective measurement, and there are many, many measures of sentiment, many good ones. I don't mean to say that there's only one good way, but what I do is, I think, different than what other people do, which is to focus on what advisors are doing as opposed to what they're saying. And so what we do is we average the recommended exposure levels in the market every day in the stock, gold, and bond markets. I just want to say in passing, I mean, the AAII has a very well-known and very well-respected and has good statistical properties, their sentiment index. As you know, people grade themselves, members of the organization grade themselves as to whether they're bullish or bearish or expecting a correction, I think is the way it's worded. And so they do that weekly. People self-report, which is always a problem from a methodological point of view, but nonetheless, the index has some very interesting properties and has been of great use to a number of contrarians. So that's another objective measure. Basically, you're looking at the self-reporting mood of many members of a large organization. What we're doing is we're focusing, as I say, on what the advisors are actually doing in their portfolios. We can discuss, and we will in a minute, what that means, but there's no doubt that if one person's, one advisor is recommending to be 50% invested, another is to be 100% invested, another is to be 100% short, which we put into an average at -100. You average all those numbers and you come up with a single value. And that's a fact of the matter. And as anyone will in the markets where you start looking at these things, having a fact of the matter is an anchor. It's something you can hang your hat on. And without it, you basically are just flopping around. So this is how we calculate our sentiment indices. So let's go to the next screen. We can keep going. I have 4 different measures. So let's keep going. So what we have found, and there are a number of ways we'll measure it here in a minute, but basically extreme bullishness is a bad sign, extreme bearishness is a good sign, and stubbornly held positions are especially significant. So what one would look at is, let's say there's not only extreme bullishness, but that extreme bullishness is maintained in the face of a declining market. That would be a very significant signal. In the same way that extreme bearishness that's maintained, stubbornly held onto in the face of a rally, it would be a good sign. There are a number of ways you can measure that. Let's keep going. So anyway, let's keep going. I'm going to have a number of charts, and then I'm going to go through some different overheads. So basically, this is a chart of a number of years ago. So basically, the red line is the average exposure to the market. This is the stock market. So this reflects broad market timing. We will also talk about market timing in the NASDAQ arena in particular, because a lot of people have NASDAQ timing systems as well. But this would be a newsletter that would have a market timing signal for the broad market, say the S&P. The blue line is the Dow in this case. So what you'll notice is that I have I've shaded in the top and the bottom decile of the distribution. So basically, I look at the top 10% of the readings. In other words, that's when you're in that top zone, they're now in the 10% of the time when they are most bullish. And from a contrarian point of view, most worrisome. And then in the bottom would be the 10% of the time that they are most pessimistic, the timers are. And you'll see that there is a correlation with movements in the market. So market bottoms tend to be correlated with extreme bearishness, and market tops tend to be associated with extreme bullishness. Now, when I say market tops or bottoms, I'm talking about it in a very short-term point of view. And we're going to talk about that time horizon over which contrarian analysis can be helpful. But if you were to correlate these two from a statistical point of view, there's an inverse correlation at a very statistically significant level. So let's go to the next chart. All the charts I'm going to show here basically reveal the same thing. This is the NASDAQ sentiment index. You'll notice that the NASDAQ timers are far more volatile. They'll go from extreme bullishness on average to extreme bearishness on the drop of a hat. But again, you'll see that there is a correlation between peaks in the market and troughs. So let's keep going. I do, now the next one's gold, same phenomenon you'll see in the gold arena. And then let's keep going again. And this is the bond newsletter, bonds newsletter sentiment index. As I'm going to mention here in a minute when I have some statistics about the performance of these indices, contrarian analysis we find works the least well in the bond market arena. And I think that's probably not a surprise. I mean, the direction of the bond market is a function primarily, especially the treasury bond market, of interest rates, and the Fed predominates in those moves rather than underlying sentiment of traders. But we'll measure that in a minute. Let's keep going. So let's go to the next chart again. So basically what this chart shows you is I differentiate all days since 2000 in which either this stock sentiment index is in the highest decile or in the lowest decile. And then I look at the S&P's performance of the subsequent week, month, 3 months, and 6 months. And you'll notice the green line is in the wake of the lowest readings, and the red line is in the wake of the highest readings. And as you'd expect, as contrarian analysis would suggest, there is an increasing spread between getting into the market when there's a lot of pessimism versus getting into the market when there's a lot of optimism. You'll notice from this chart that the biggest spread between the green and the red lines is at the 3-month horizon. And that in general is what we have found. It doesn't exactly work every time at that point, but I would say that contrarian analysis, and we'll see this from some other charts as well, does not provide you much guidance into where the market may be headed further down the line in the next 3 months. So, and indeed, some of my sentiment indices, their greatest explanatory value is at a month horizon. So, so I typically, in answer to your question, I'll say maybe next 1 to 3 months, but it's not going to tell you where the market is at the end of this year or further down the line. But it does help you decide where the conditions are optimal for getting in or out of the market. I want to say that first of all, I'm not an investment advisor, but secondly, you don't have to be a short-term trader to use the insight of contrarian analysis. Let's say you have money, you know that at some point this summer you're going to have to take money out of the market to pay for a child's college tuition or something like that. So it's a significant chunk. You would just want to watch, for example, times when sentiment is at a very bullish extreme to do that, because that's a good time to pull money out of the market, because the sentiment winds will be blowing in the direction of lower prices. Same way, let's say you have a lump sum you're going to put into the market, you could wait until there's a lot of pessimism out there, and that suggests that might be a good time to put money in the market. So let's keep going.
Could I throw in a couple of questions, Mark?
Sure.
There's two related. I am a DIY investor of 30 years, and I have scars to show that on average, I lose when I listen to and follow experts, and do better when I work on my own instincts and study the trends. And then second question, I also feel that I do worse when I listen to the experts, because they are pushing stocks and that have already done well. And that is the power of contrarian analysis.
Yeah, I would definitely agree with those points, especially the second one. That can you imagine? That CNBC would only write about those things that have done terribly. I mean, it's not very good for ratings, right? I mean, they want to write about the stocks that are hot, because that's that's what gets people interested, and it's exciting. But But and this isn't a criticism of CNBC. I think every media company is in the same boat. They're in the business of entertainment. It's excitement. It's not necessarily what will do well over time. So this chart basically adds the Russell 2000 above and beyond the S&P 500. Same particular phenomenon. Though the reason I include it is notice that the spread between getting in the market when sentiment is extremely pessimistic, which is the purple line for the Russell now, and getting out of the market versus when there's a lot of optimism, which is the light green line at the bottom. The spread between the light green and the purple line is greater for the Russell than it is for the S&P. And I think that makes sense. I mean, I think if we were to try to imagine in advance what sector of the market will be more vulnerable to sentiment swings, we'd probably pick smaller cap stocks rather than large cap stocks, because the smaller cap stocks are more a function of the mood, the consensus among retail investors, who are more susceptible to mood swings anyway than large institutions, which are probably less immune, though not completely immune, as we see. So that's the point of this chart. So let's keep going. I'm going to try to go through some charts here fairly quickly. So this is the NASDAQ composite, same general phenomenon. They'll notice that the 6-month arena, that the lines cross, so there's not a statistically significant difference at the 6 months. But this is another way of just making the point that sentiment's not going to tell you where the market will be 6 months or later down the line. In fact, there's no difference, as we see. So in here, in the maximum spread is at the month horizon, and there's no greater at the 3-month horizon. So NASDAQ sentiment is very short term relative to the S&P. Okay, let's keep going. So now that I'm focusing on gold, I use the gold miners ETF, the ticker is GDX, as a way of reflecting sentiment here. And it follows the same pattern, though I think, again, the thing to emphasize is the spread between the green and the red line is greater here. Notice that at the 3-month horizon, we're at something like 12 percentage points difference between getting in when the market is, when the average market timer is very bullish versus very bearish. And again, I think that makes sense. I mean, if we were to say, what are the factors that affect gold? A lot of people probably would say there's some fundamental factors like inflation data, but it turns out that it's a very difficult argument to make that inflation is very correlated with gold. Over many, many decades, the data suggests there is some correlation, but over short-term or even intermediate term of several years, even to several decades, there's very, very little correlation between gold and inflation. Which is just the reason I point that out, is to say that, in fact, I think you and I would agree, if we were to a priori look at this and try to imagine, we would probably have guessed that gold was most susceptible of any of the major assets to sentiment swings. And that's what we're seeing. So if we were to grade the markets as to be most or least susceptible to sentiment, I think we'd probably put gold near the top. We saw Russell 2000, small cap, mid cap stocks more susceptible than large cap stocks, and indeed that's what we saw. We're going to show a bond here in a minute. We'd probably think that bonds are the least susceptible to sentiment swings, and that's indeed what we find. So let's look at the next chart. Indeed, you can see hardly any difference in the return of the Treasury market in the wake of high and low degrees of pessimism and optimism. So yeah, and that's just another way of saying that you pay attention more to what the Fed is doing than you would to sentiment among bond traders. Not to say that bond traders don't have some impact, but it's relatively modest relative to Fed and other factors. So let's keep going. So this is where my sentiment indices stood as of last night. So we updated it at 5:30 Eastern every day. So it reflects all market timing recommendations we've received by then. So it's in real time, though if an advisor hasn't updated, then of course we can't reflect his or her latest opinion, but it reflects everything that we've received by email or fax or whatever, you know, in our office. So the average exposure, first, if we look at the stock market, this would be exposure to the broad market like the S&P. The average exposure is 30.71%, which is, and then you'll see in parentheses where that stands in the percentile of all readings since 2000. So it's at the 39.5 percentile, which is to say about 60% of the time over the last 2 decades, the market timers have been more optimistic than they have now, and about 39%, give or take, less optimistic than they are right now. That's very much in the neutral zone. I mean, if you were to look at or try to, you know, construct an econometric model that would predict if the market is at this particular reading, you'd find no statistical significance in any projection. The only statistical significance we have found is at the extremes. So when there's extreme bullishness or extreme bearishness, it has significance. But for the great mass of time when they're in the middle, it basically, you say the market may go up or down, but contrarian analysis doesn't really help you. Now, the NASDAQ, we're starting to get a little more interesting because it's a much higher exposure to the market among NASDAQ timers. I'll go off on an aside here. It's interesting to me that there are market timers we follow who will have 2 models, one for the S&P and one for the NASDAQ, and they'll be significantly more or less bullish in one than the other. And right now is one of those cases. So the average exposure to the NASDAQ is 67.74%, basically 2 out of 3, 2/3 of the portfolio to be exposed to the market. And that's higher than 83.9% of all readings since 2000. We just use as a matter of sort of a rule of thumb, we look at the top and bottom deciles, as you saw in those charts earlier. So we're getting close to being the top decile. Is there a magic threshold to be at the 90th percentile rather than 83.9%? Probably not, but that's how we've sliced and diced it in the past. So we're getting close, is an overall message. We're getting close to excessive bullishness among NASDAQ timers. And then quickly in the gold arena, it's again relatively in the middle of the distribution, 35% being the average exposure to the gold market, which is higher than 61% of all readings since 2000. The bond sentiment index were at basically close to 0. I mean, an average exposure of negative 4.63, which is you know, slightly short the market, not much, and that's also higher than 35.4% of all readings. So, but for the NASDAQ, I would grade the current sentiment readings as pretty much all solidly in the neutral range. And the NASDAQ's the one that's getting close to the extreme bullishness that would suggest caution. So let's keep going. Oh, okay, yeah, this is just for more information. I think we can leave that screen up in case you want to look at my website and so forth. But that ends what I wanted to go over. I think we have about 20 minutes for discussion, and so I'm open to any and all questions.
Okay, Mark, I'll run through a bunch of these. One lists a number of factors that influence the market and what's going on, but it was pointed out that incompetent management is a significant factor. Do you feel that is a significant factor in momentum trading?
We see the thing about, you know, I'm going to say 2 things. One is more theoretical. People always come up to me after my talks and will say, well, what about this approach? Don't you think, you know, this is the one that will work? And they sometimes will have computer printouts and all kinds of statistics that will that hopefully sway me to say yes. And my answer in every single case is I don't think it'll beat the market. And the reason is that I know I'll be wrong about 5 or 10% of the time, but I'll be right 90% of the time. And why wouldn't I take odds like that? And that's what I'm going to say about this. I mean, am I saying that incompetent management doesn't matter? Of course it matters. And so it's not, I'm not saying that incompetent management is an irrelevant factor. What I'm saying is that, and this is the presumption of the efficient market, is that all publicly known information is reflected in stock prices. Is that 100% true? No, but it's a pretty good operating assumption. So we have to basically the presumption of when we try to beat the market is we're trying to assume we know something that the market doesn't. And it's extremely difficult to show that, because every time I discover something, it's because it's already on the internet, and it's because I've read about it. I mean, it's very, very difficult to come up with an insight that no one else has. And that's basically what we're trying to presume when we think that we've come up with a factor that no one else has ever looked at. Now, again, I'm not saying you shouldn't try to beat the market. That whole middle section of this talk was to basically say it's still rational to try. I'm not saying you shouldn't try, but you should know that the odds are not good. And the way to think about it, I think, it creates a certain humility, which is always a good virtue anyway, but do we know something the market doesn't already know? And it's very difficult to make that argument.
Okay, Fran made the comment, I hear you, SPY, which is the S&P 500 ETF, beats
Right.
trading.
Say that again, needs what?
The statement is, I hear you, SPY, which is the symbol for the S&P 500 ETF, beats trading.
Oh, yeah, I mean, again, it's a seemingly contradictory thing I'm saying. On the one hand, I think, it's not irrational to put everything in an index fund. However, it's not irrational to try to beat the market too. But you don't do it all or nothing when you want to try to beat the market. Again, if you are a skeptic as I am, it would still be rational to put in, 25% of your portfolio into an active trader, actively traded, actively managed portfolio. So that would not be irrational. But I think the odds of beating the market are extremely poor. But you have to have even more extreme skepticism to justify never putting anything into an active manager.
Okay, this is a bit long, but it's an interesting question. Are you saying that momentum does not work? I recall you writing an article years ago. If I remember correctly, it said momentum works in a smooth market, but not a volatile market. What about newsletters such as No Load X out of San Francisco, which relies on 1 month, 3 months, 6 months, and 1 year weighting averages?
Right. Well, so a lot of research, and I'm not the origin of it. A lot of very good research has been done over the years in academia as well as on Wall Street on momentum strategies, and they've sliced it and diced it in a number of different ways. What I am impressed by is that there does seem to be this phenomenon that at least academics refer to as momentum crashes. That there are times when momentum just does extremely poorly. Even if it's most of the time it does moderately well, then there are times that it does so poorly that it can make up for many years of moderately beating the market. So it's always so interesting to me. Momentum has worked historically, but the question is, does that mean it'll work going forward? And the answer to that question depends on believing that the factors that led it to beat the market before persist into the future, which includes that people didn't know about it, but now people do know about it. And so it becomes a very difficult, it's a separate question. It's not, has it worked historically, but the question is, will it continue to work in a way that most people won't know that it's working and therefore not try to jump on the bullish bandwagon? There's a guy who I quote a lot in some of my columns, one of the smartest people in the market I ever met. He's not an investment advisor, so he's not in the business side. We're not going to give you his name. It's not like you can go out and follow his advice. He's mostly in index funds anyway. But basically, I'll say, somebody will ask me about a particular strategy, and I'll call him and I say, what do you think? And he said, I've never heard of a rational, plausible explanation for why that phenomenon would exist. But even more importantly, the moment that people figure out why it works, it'll stop working, precisely because people have figured it out. I was having a conversation recently with Norm Fosback. I think many of you know him. He was the head in the 1970s and 80s of a group called the Institute for Econometric Research. He's a very serious student of the market. He wrote a book called Stock Market Logic, which is really a classic textbook of different techniques. And he really studied things in a very rigorous way and came up with a number of indicators that worked in the 70s and 80s. And what he told me is, he says it is so humbling to see in the early 2000s as well as the 2010s, how indicator after indicator, this is his words, that used to work fall by the wayside. And that's exactly what you'd expect given an efficient market, right? And it's not that, but you can have some of the best statistics and you can come up with indicators that have statistical significance at high levels of significance, which is what Fosback did. But that doesn't mean that they'll continue to work, because one of the crucial preconditions for them to continue to work is that people don't know about it. But yet he's in the business of making people aware that these indicators existed. So I mean, it was almost like he was partly killing the goose that lays the golden egg.
Okay, next one. What effect, if any, would you expect high frequency trading on the data? Have the measurements borne out your expectations?
Well, I would imagine high frequency trading, on the one hand, can reduce the intensity of previous patterns and could exacerbate others. I mean, in other words, you can imagine less volatility in some instances and greater volatility in other instances because of high frequency trading. And it really depends on the algorithm that the high frequency traders put into their systems. And what I understand, I'm not at all an expert in the algorithms that they use, but those algorithms constantly have to be updated. Because, for example, let's say that they're like, in fact, one high frequency trader was calling me the other day, and I'm gonna bastardize what he said, and this is to makes it appear more simplistic. But the idea is, like, if a stock is down for 3 days in a row, then there's a greater than even chance of it being up on the 4th day, and that sort of thing. There are many patterns like that on a very short-term basis. You're probably aware of probably the most successful hedge fund out there is Medallion Fund by Jim Simons, and it has, even after fees, it produced something like a 38% annualized return over the last 30 years. It's phenomenal, and his average holding period is measured in minutes, and the average the success rate, I'm told, is just barely above 50%. So in other words, it's he trades millions of times a day or year or month or year. But if you're right just slightly more than 50% of the time and you have that many trades, you can end up making money. But what my understanding is that what used to work for him and his fund back 30 years ago doesn't work anymore. So he's constantly having to, and indeed he's a mathematician, and he hires some very, very smart PhDs in math to constantly look at how the market is changing. And there are a lot of people playing that game right now. And so I would say the odds of him continuing, why wouldn't I bet on him? Of course, you can't invest in his fund. It's only available to partners in his hedge fund. But nonetheless, if you were to bet on somebody, why not bet on him? But nonetheless, I would say the chances of him continuing the success are smaller now than they were back 30 years ago when he was the only one playing that game.
Okay, question. We should buy growth stocks when they are out of favor, even though our brain tells us to do the opposite.
Well, that's not a bad idea. First of all, growth stocks that are out of favor sometimes are called value stocks. I mean, so there's a lot of one has to be rigorous about these sort of things rather than so this is where I think the terms growth stock and value stock sometimes are less than helpful. But out of favor generally is a good approach. That's the contrarian approach. You buy when things are out of favor. And this is that point that I was saying earlier, where Buffett is famously saying that you should be greedy when others are fearful and fearful when others are greedy. And that just goes exactly opposite to what we want to do. Our instinct is when everyone's scared to death, we're scared too. And when everyone says market's going to go to the moon, we think we're a fool not to put our money in the market. And so we are human beings. We are susceptible to the same mood swings that affect everyone else. And that's probably another way of putting why the contrarian analysis works. It's not necessarily that the stocks that do well aren't, they could very well be popular. The question is, are they popular enough to still outperform, given that a lot of money has been piled into them and propelled the stock up relative to underlying fundamentals? So basically what the interaction of human excitement and pessimism on a stock will cause the market to move to extremes. So when there's a stock that looks good, the performance will be so good that it's unlikely that it'll continue to do as well as people are betting. I don't know whether I made that clear. I mean, an example I often think of is, let's say you go to the horse track and you can bet on any of the 10 horses. Usually, of course, you can only bet on some of the ones that have higher odds. But let's say you could bet on any of the horses in a 10-horse race. And the odds-on favorite is the one that thought to be most likely to win. And what if you bet on the 10th horse? And let's say, in other words, the one that had the poorest odds. So you put your money on the horse that has the worst odds, and it comes in 7th, whereas the horse that was the odds-on favorite comes in 2nd. Well, that horse that came in 2nd, still a faster horse than the one in 7th, but you could make more money by betting on the 10th, because going from 10th to 7th might increase the payout better than what you'd get if you bet on the winner who ends up coming in 2nd. So it's not that you're saying objectively that one horse is better than another, or that one company is going to make more money or less than another. It's whether it's going to continue to do better, so much better than what people already expect. So it's beating expectations that causes you to make a profit, not just whether you're right about the direction of the company's bottom line. I can't hear you, Lynn.
There was a question about when will the recording be available? That will be in about a week. So that's just a general question. There was a question, where is sentiment now? You had a slide on that. Do you want to make a comment?
You could go back a couple slides to go show what that is, yeah.
Let's see, if the market is efficient and have all available information priced into it, then the crowd should be mostly right. Why then, why are they suddenly, let's see, why then they suddenly be wrong? Oh, okay, anyway.
But no, I think I understand. I mean, it's a fair point that, I mean, if all the available information is reflected in the market, and part of that information is the fact that they have moved to extremes, but maybe that, maybe that's part of the information that's already reflected in the market. Therefore, it's, contrarian analysis shouldn't work in that case either. That's a very fair point. I think I would differentiate between a sentiment of investors on the one hand and information about companies, underlying profitability and future success or not on the other. So the available information includes everything about the company, the economy, and so forth. And then our sentiment comes in as sort of an overlay and causes us to move to extremes relative to what the underlying data would suggest. But that may be not the final word on it. I don't claim to have the best theoretical understanding of that, but that's the way that I think it works. That so the available information is about the company's prospects, the economy as a whole, and so forth. Whereas the reason contrarian analysis works is that we react in an emotional way to that underlying fundamental data and cause things to move to an extreme, either positive or negative.
Good. Will doing opposite of sentiment extreme stop working when people know about it?
Well, that's a good question, but then in that event, there wouldn't be a sentiment extreme, right? So let's say, and this is the advantage of my looking at sentiment the way that I do, which is that market timers will say, I want you to be 100% invested. But let's say they say, well, I'm now going to be a contrarian against myself. So the fact that I'm so bullish means means actually it's a bad sign, so I shouldn't be 100% invested. But then they would move their recommended exposure level down from being 100% invested, and therefore would be reflected in my sentiment index, and there wouldn't be a sentiment extreme after all. So I think by focusing on what they're actually doing in their portfolio as opposed to what they're saying is a way of immunizing yourself from that possibility. But in general, I'm sympathetic to this comeback, which is that there's sort of a hall of mirrors aspect to contrarian analysis. That, if you become too bullish, oh, well, therefore I must be wrong, and therefore I'm not going to be bullish again, or bullish at least to the same extreme. But, and this is why I think it's so important to have an objective measurement of sentiment, because otherwise it just becomes, as I say, this hall of mirrors where it's an excuse for sloppy thinking. But yeah, I think if you're focusing on what newsletters or market timers or hedge fund managers or mutual funds are actually doing, as opposed to what they're saying, you can immunize yourself from the possibility that they're trying to second guess themselves from a contrarian point of view, because there's a fact of the matter. We know, are they fully invested? Are they in cash? Are they fully short, or what have you? And that's a fact of the matter.
Mark, we're at 10:30 our local time. Where there's 4 more questions. Do you want to try to do those, or?
Let's do the 4, yeah, and then
Okay,
say
and then
call it a day.
won't go to any more. So what is the bottom line by SPY for most of the portfolio, and invest a portion 20 to 30% to satisfy the itch that I can beat the market and hence improve my overall return?
Right. I think that's a good way of putting it. That's very well put. I think, whether it's 25% or 30 or 10 or 15, I mean, the point of that study from the Journal of Finance that I provided the citation to earlier is that there is no way that statistics can tell you what the right answer is. That's the thing that's so interesting about that research, is that there's a broad range of what is rational. It's rational to say you shouldn't try to beat the market. It's also rational to put a chunk of your portfolio into the manager who has the best track record. And we would need, I mean, at least the professors argue, you would need, decades and decades and decades, probably well more than 100 years of data on thousands of different mutual funds to resolve the question of which was the most rational course of action. We don't have that much data. So therefore, it really depends on things like our predisposition. So I think not going all or nothing into active management is probably a good idea. But there's not going to be a single answer to the question of how much you should go with an active management.
And then how can we be notified or know about new articles that you have published? Well, I guess the question is, where can we look for your articles in?
Well, yeah, it mentioned, you'll see there, I have periodic columns. I have one almost every day at MarketWatch. So just you can go to MarketWatch and just search on my name. There's a search bar there. I write for Barron's and Wall Street Journal on I think it's every month is the periodicity of it right now. So.
Okay, and lastly, so your sentiment indicators only based on newsletter advice that you track and based on mutual funds and hedge funds out there. If you
I don't track, my sentiment index is not based on mutual funds or hedge funds. There are indices that focus on those them as well. But we're focusing just on investment newsletters. And it's more, we look at more newsletters than those that we actually track the performance of. We used to track several hundred newsletters, and we continue to receive many of them. Many of them have chosen not to have us audit the returns, but we still receive their newsletter. And so we'll include them in our tracking of the average exposure to the market.
And then finally, Frana and French identified 3 factors: 1, risk/return; 2, size, small cap; 3, price, such as value. Does it mean that portfolios should include large cap and small cap?
Well, that's a very good question. So the Fama French data, first, I mean, yeah, they used to have 3 factors, as you mentioned. So size and the growth value dimension were the 2 of the prominent ones. They, you could say this is evidence of market efficiency. They have not worked on average since their initial research came out in the early 90s. I mean, they've worked some years, but on balance have not worked. They're now up to 6. They're now up to 6 factors. So it's you'll hear in the literature they're talking about a 6-factor model now. And so, in fact, you could add factors ad infinitum. I think the latest count was some academic was looking at. It's gotten out of hand, but one was up to 460 separate factors that have been identified in the academic literature, and that they all claim to, of course, have been statistically very significant during the time that they were measured. This is going way off on a tangent. I think many of them don't really work. Yeah, I don't really want to go off on a tangent, but if you want to look at there's a guy at Duke University, Campbell Harvey is his name. You go to his website, and he has research on how many of those original factors, those 460 factors that have at least some academic evidence in their favor, work out of sample, which is to say that if you pick a different sample of history or different country or whatever, do they continue to work? And hardly any of them continue to work. Not none, but most of them do not. So that's it's a very humbling business. And again, it's back to the notion of market efficiency.
Good. Thank you very much, Mark. Just a comment to everybody, if you go down to the bottom of the chat window and click on the 3 dots, you can save all of the questions to your computer. These were very good questions. Thank you for those that provided the questions to us. And Mark, we really appreciate your spending your time on a Saturday morning, sharing your wisdom with us. And anything else you want to just close with?
Oh, yeah, don't get me started. So anyway, but thank you so much for all of your attention, and look forward to maybe one of these days we can be in person again. But in the meantime, it's very convenient just to sit on my desk here. And anyway, hope everyone has a great day.
Thank you. And thanks to all those that have helped put on this webcast. And by the way, just a quick reminder, in September, we have Jeffrey Hirsch speaking to us. We have an estate planning program in November, our tax program in November 11th, and then January, we're going to try to get a speaker on the S&P 500 in 2024. So have a great day, and thank you very much.